Welcome. My name is Mays Hamad Al-Thani, and I'm the Managing Director for the US-Qatar Business Council Doha office. Thank you for taking time to join us today. US-QBC has partnered with Georgetown University in Qatar to bring you a stimulating discussion on navigating markets in the current political and economic climate. We are very pleased to be long-standing partners with Georgetown University in Qatar and to support the Qatari and American business communities through these various initiatives. Today's webinar will offer an in-depth commentary on navigating markets during this precarious time, while understanding the recent financial transition to the virtual economy and its limitations. We are delighted to have Dr. Antoniades with us today, and we look forward to hearing his insights on the global financial market in the current economic and political climate. In his talk, Dr. Antoniades will discuss both the causes and consequences of inflation, as well as the steps the Federal Reserve can take to react to it. He will also explain what consequences these may have on markets and on businesses. The discussion will introduce the role big data play in providing valuable insights and guiding business decisions. I would now like to invite Ms. Dima Wahbe, the Head of Business Development at the US-Qatar Business Council Doha office, to introduce our esteemed guest speaker for today's webinar.
Thank you, Sheikha Mais. Good morning and good afternoon to our audience. For today's special event, we have a distinguished speaker from Georgetown University in Qatar, Dr. Alexis Antoniades. Dr. Alexis Antoniades is an associate professor, director, and chair of international economics at Georgetown University in Qatar. A Fulbright scholar with a PhD in economics from Columbia University, he is an expert on global markets and a leading authority on the economies of the Gulf countries, Qatar in particular. He is the recipient of a $1,050,000 research grant awarded by Qatar National Research Fund to undertake the first micro-study on the economies of the Gulf countries. And along with colleagues from Qatar University, a recipient of an $867,000 US research grant to use social media and analyze sentiment in the Arab world. His current research is on big data, prices, and job vacancies. Dr. Antoniades previously worked as an assistant economist at the Federal Reserve Bank of New York and Princeton University as the recipient of the prestigious Niehaus Fellowship awarded to the most talented scholar on issues of globalization and governance. In his 14 years in Qatar, Dr. Antoniades frequently advises the leadership of both public and private sector organizations. Given his vast academic and professional expertise in the field of international economics, Dr. Antoniades is the ideal guest speaker to discuss the effect of the ongoing crisis on world markets. The recent geopolitical developments in relation to the war in Ukraine have afflicted not only victims of the crisis, but also the interconnected global financial system. With the rapid rise in inflation, businesses, consumers, investors, and governments worldwide are re-evaluating their business strategies. Another interesting development has been the move from the manufacturing industry into the service industry and its effect on the economy. This recent transition has raised several questions and uncertainties about the exact nature of these financial assets. Dr. Antoniades will provide our audience today with a coherent framework that will bring together concepts of cryptocurrency, blockchain, NFTs, the metaverse, and the virtual economy. Before I hand it over to Dr. Antoniades, I would like to remind our audience that you may submit your questions in the Q&A box at the bottom of your Zoom screens. Dr. Antoniades will address some of these questions after his presentation. And with that, I would like to hand it over to Dr. Antoniades.
Thank you, Dima. That's a very kind introduction. And thank you to Sheikha Mais for opening this talk and for the invitation to present. And it's an honor to be in front of this great group of attendees and to talk about prices and metaverse and a lot of things that have been going on. Okay, so let me start. And what I would like to do over the next 20 minutes is to create a common framework for us to have a nice discussion later on, because you all have different backgrounds, you come from very different industries, but we all have one thing in common. We observe that prices have been going up, and maybe to some extent, we observe that the Fed failed to realize early on that prices have been rising. So I want to spend some time to discuss that. What is inflation? What are the causes? What's the role of monetary policy? and I'll try to be as specific as I can be. In discussing that, I will bring the role of big data. But that's one thing that is going on in our lives. The other big thing that is going on for businesses, while they have to deal with the war in Ukraine, the uncertainty in the stock market, rising prices, rising costs, is this transition from, as Dima said, we started as an agricultural society, we moved on to manufacturing, we moved on to services, and then there's this virtual economy, this metaverse, and companies are trying to figure out what it means for them, where the challenges will be, but also where the opportunities. And again, they are doing that while we have all this uncertainty going on in the market. So if I had to visualize that in one picture, it's like me taking the kids to the park, and one kid wants to run to a playground. That's a metaverse. They want to run to the playground, and the other kid is pulling in the opposite direction to go to the ice cream place. And this is what company leaders have to decide to do. I mean, they want to figure out the transition to the virtual economy, but they have to deal with rising prices and uncertainty and the current challenges. Okay, so a lot to cover. I'll keep it very simple. So let me start. We know inflation is about prices. It's the rise in prices over a period of time. And we all know that regardless of where you live, regardless of where you spend your money, prices have been going up. And there are two main reasons why prices are going up. One can be fundamentals, and the other one can be expectations. And it's very important we understand that early on. So prices can go up because we have supply side bottlenecks. So during COVID, and this is a view of the Fed, during COVID, a lot of production facilities had to shut down. A lot of port facilities in China had to shut down because people would get sick and they would have to stay home for a month. And that created problems in the supply chain. And those bottlenecks had a trickling down effect, and that pushed prices up. So this can be fundamental reasons why prices go up. Now, expectations is when we think prices are going up, and then if we are a company, we start raising our prices. Our staff is asking us to raise their salary, or if we are hiring people, they're asking for high prices because they think prices are going up, and that can become self-fulfilling prophecy. So if you are the policymaker, in our case, the Fed, and you want to control prices, you have to deal with both fundamentals and you have to deal with expectations. So in the case of the US, if you don't mind, let me share some simple graphs. So what you have here, you have the core CPI. This is CPI, the Consumer Price Index in the US for all items, including food and energy, over the last 60 years. And with a shaded gray line, you find the US recession. So what you find is that the Fed has been very good at keeping prices around the 2%, which is where we want inflation to be. Sometimes it's lower, even negative. Sometimes it gets very close to 5%. But we have several episodes. We have the twin shock in the 70s with the oil prices, where prices went substantially higher. But I draw your attention to the last few months. You can see there's a sharp increase in prices, very, very steep. And if we look at the last 20 years, 30 years, nothing compares to that in the last 40 years. It turns out that inflation now is at a 40-year high, the highest since 1982. So this is big, and the Fed somehow missed that. Let me show you what inflation looks like when we take out food and energy, and we tend to think that energy shocks have been driving prices, especially with Ukraine. So let's take it out. And here I have urban consumers. So I have inflation that people living in urban communities face. And you see it's a little bit different, and it's always a little bit higher. But especially now, it's shocking when you see the increase in urban CPI. And of course, what's the difference, you may ask? And the answer is mainly rents. Rents have been going up, and people living in urban communities, they spend a higher share of their income on rents. Why do I show that? And let me And let me add the Fed funds rate, and then I will explain why this is important. The Fed fund rate, the interest rate, is sort of the mechanism. So let me stop. Is a mechanism the Fed has to drive prices down. And this is important to explain for the audience. If the economy is slowing down and we would like to stimulate the economy, we lower interest rates. We reduce the Fed funds rate. And this spurs investment. It encourages people to take loans. If the economy is growing very fast, the challenge is that the economy is overheating. So at that point, what we would like to do, we want to slow down the economy. We would like to hit the brakes, and we do that by raising the Fed funds rate. Okay, so let's go back to the graph. And you will see that during the oil shocks in the 70s, the Fed raised interest rates. And then in, of course, 79, when inflation went close to 15%, they raised interest rates substantially, and that caused a recession in the US, the dual recession of the 80s, and it actually pushed 40 countries to the verge of collapse, because when the US has a recession, the rest of the world suffers. But you can also see how when prices are going up, the rates are going up. And then what follows is recession. Okay, because you hit the brakes on the economy. So have a look where we are right now. Fed fund rates is almost zero, and inflation has gone through the roof. And this is, if I zoom in this period, again, this is what it looks like. So things are serious. And but the Fed missed that. And I will show you some statements. I will show you the narrative coming from the chair of the Federal Reserve, Jerome Powell. He said that as early as July, he was saying inflation is transitory. We see some increase in prices, but this is really caused by supply chain bottlenecks. That wasn't the case. I think the Fed failed to realize that, yes, there are supply side bottlenecks, but those have cascading effects, long run effects. But it's not just that. Going back to the graph. Look at urban consumers. The gap is rent. Rent is not about supply chain bottlenecks. An increase in rent is not transitory. That has a more permanent nature. So the data was there. This is a producer price index. Same story. We see increases in prices that we haven't seen in 3 or 4 decades. But I want to focus on this. I want to focus on wages. I will come to that. Many of you are running businesses, and one of the challenges you have seen post-COVID is the difficulty by which you can hire people or retain. Something happened during COVID. When people stayed home, many decided to quit their jobs. Many decided that to come back, they needed higher salary. And many decided that even if they came back, they could leverage the current environment and seek better jobs. So if you run a company, one of the things you observe is the difficulty by which you hire people. You have to offer higher salary. And even then, it's very hard to retain that. So wages have been going up. There was a structural change because of COVID, and the Fed failed to realize the change that took place in the labor markets, to me. But once you get people and you offer higher salaries, this is not transitory. Then you have to raise the salary of everybody that has been working at the company for many years. And you see, this is the posted wages in the private sector. Again, a similar story. We see the numbers going up. So in November, I was talking to many business owners in many different companies all over the world, from investment firms to like running delis to running different service law firms and so on. And there was a common pattern, and the pattern was the following. It's so hard to hire people. We struggle to hire people. And I recall one time I was having dinner with a firm. He has an investment firm. in Europe and in the US, and he was complaining about that. And we were in a small restaurant having dinner, and the owner was serving our dinner, and he's somebody the team knew, and they said, how come you don't have staff? And he says, it's impossible to hire people. So you see the range, so many companies having a hard time hire people. So what I did, and this is where big data can be very useful, but I lost my, okay. In part of my research is using big data, using micro level data to answer macro questions. So one of the things I've been doing is collecting job posting data in China. So companies go to these online boards and they advertise positions. So starting from 2019, I've been collecting this information. This is more than 170 million posts. And there's information about salary. So I went to my data after I had that experience. That was mid of November. And I said, let me see how salaries changed in China. In China, COVID appeared at the end of December 2019. So this is a period of instability. Of course, this is not post-COVID, but China had a program to encourage the hiring of workers until end of July. It was phased out. But even then, you don't really see salaries going down. You see a spike up and then this correction, but then salaries continue to go up. And that was shocking to me. At that point, it was very clear. It was very clear that inflation is not transitory. It was very clear that there is inflationary pressure coming from wages, and the Fed failed to realize that. And it was very clear that the Fed would soon realize inflation is not transitory, that the Fed would have to move faster to raise interest rates, and they would have to hike rates more than markets anticipated. And once that realization would be realized, markets would come down. So I'm advising a family office. It was very clear to me at that point, we exited our investments in equities. This was the environment back then. But now moving to the environment now. This was even before the war in Ukraine, before the spike in oil prices. And you see oil prices came down 30% from last week. So there's a lot of uncertainty, a lot of volatility in the market. So what does that tell us about the future? And I know some of you have questions about the situation and how it's going to affect us. So let's try to think from the point of view of policymakers. If you are the Fed right now, you have two objectives. One is to drive inflation down, and you do that by raising interest rates to do two things. Slow down the economy, so reduce the demand, ease some of the pressure, but also manage expectations. That's why I said that. But now the Fed also has to save its reputation, because the reputation of the Fed is at stake here. They failed to realize the increase in prices. Everybody now suffers from the increase in prices, so their reputation is on the line. So they will have to move in and raise rates. But in this environment with the war in Ukraine, there's a lot of uncertainty. My view is that they will have to raise rates. They start from a very, very low base, close to zero. So there's a lot of space to go. And if later on we see a substantial slowdown in the US economy, which is necessary to bring prices down, but not sufficient, they will have space to start reducing interest rates again. But to have that space, they will have to raise interest rates. The challenge is the following. Now there's a new reason why prices are high, and this is supply shortages. So if because of the war in Ukraine, we cannot have access to wheat, and there's limited supply of oil and LNG, changing interest rates will have absolutely no impact on the supply. In fact, raising rates will discourage investment in these areas. So the ability of the Fed now to control inflation is weaker than it was 3 weeks ago. And this is the environment we live right now. So with this in mind, let me just emphasize again, as business leaders, I think we can use big data to drive our decisions. I gave the example of inflation, but while the Fed waits for the Bureau of Labor Statistics to give them data on inflation that they collect every month, we can get data every day. You can go to your local supermarket and every day you have prices. And it's very easy to scrape those prices to download. And this is what companies and funds are doing now. So they can track how prices are changing in real time. I gave you an example of how we can track changes in salaries in real time. So I think big data will change also how the Fed gets its information, but definitely it changes how companies reshape their strategies. And I think that brings us to the next part, which seems a little bit disconnected. But there's a lot of discussion about the metaverse and how that's going to affect companies. And there's a lot we can say about that, and I don't want to get into crypto coins and altcoins. This is not the point. But I wanted to share some thoughts. I shared thoughts on inflation. I wanted to share thoughts from my point of view, how I try to make sense of what is going on. And I start with some patterns. I will use this watch as an example. In a typical model, we buy something because it has some value to us. And the value comes from the usage. But this watch has some value also because I like the watch. Every watch can show me the time, but I like this watch. And then there's another component. So in addition to the usage and how much I like it and scarcity, one component now that adds value to this watch is that other people can see that I'm wearing this watch. And because of that, I'm willing to pay a little bit more. Okay. And this is how we will build some understanding of what the metaverse may look like for companies. So if I'm able to show this watch to 5 people, I'm willing to pay a little bit more. But if I'm able to show this watch to 100 people, then I'm willing to pay more than that because I get more value that the 100 people will see I have this watch. Now let us think what happened with Instagram, because there was a change in our business models that is not quite understood. Now, if I have a photo with this watch on Instagram and I'm an influencer, maybe 1 million people will see me. So now the component that I get satisfaction from people that can see I have this watch is much higher, way higher now with social media. So I'm actually willing to pay a lot of money for this watch, money I would never be willing to pay, not because from the usage. The watch provides the exact same usage as it provided before. But now there's another component, which is the show off, that people can see I have this watch. And that can bring me even more followers, so I can make money. So it's not just show off, but there's a different business model now. So I can pay a lot of money. And this is what we have seen. People paying a lot of money, not for the usage, but for the influencing factor. So if we think about the metaverse now, the metaverse, and we think of it as a space where we can all be there, then even more people can see I have this watch. So I'm willing to pay a lot of money, but I have to be somebody, right? I need to have an avatar. So I'll come to NFTs, but let me go back to the watch. In the example I gave with influencers, the value I get from others seeing that I have this watch dominates the value I get from wearing the watch. Actually, I don't even care if I'm wearing the watch, if it shows the time, because that component became so small now. So in fact, I wouldn't mind having a virtual watch on my metaverse because I don't care about wearing it. It's all about showing and getting followers. And this is what is happening. You need NFTs for that. I cannot just take a photo, but we need to have scarcity. So NFTs is a way to have scarcity. And I need to have my avatar, my profile, my photo. So I'm willing to pay a lot of money for NFTs to establish my status in that space. And of course, that information has to be accurate. And that's why the development of blockchain is so important. And once you are in that space, then you engage in transactions. And for that, we need to have the crypto coins so we can engage in transactions with each other. But then we can build our own world there. We can still invest in real estate. And it sounds crazy, but if you think about it, you buy a house because you want to live in, but many of us have made investments in real estate because we expect the price to go up. And we buy location, location, location. You can do the same thing in metaverse because that's where people will be spending their time. Not because they want to live in that place, but it's a financial asset. Price will go up. And that will become a self-fulfilling prophecy, so price will go up. What does that mean for companies? And I think that's a good space for me to conclude, so we have time for Q&A. I use the example of Nike. Nike went and bought a few months ago a company that makes NFTs to take Jordans from physical assets to virtual assets. And this is what many companies will need to do and will struggle to do, because consumers, I think, and this is my view, will start buying less physical assets because it doesn't give them the same satisfaction as having a virtual asset that you can park there and everyone can see. And companies will switch from producing the physical assets to producing the virtual NFT versions of those assets. We are not there yet, but if you think about it, the society is pushing us in this direction. I have 2 kids and I worry what type of world they will be living in, but this is where they're going. We have the technology with NFTs, we have the technology with blockchain and the currency we need to use. So that's where things are going. And to conclude, and thinking about Facebook and metaverse, I don't really think metaverse will come from Facebook. I see my kids spending time on platforms such as Roblox and Minecraft, and what they do, they build their own communities. You can have concerts for kids on Roblox. So our kids are already in a space that we don't really understand very well, but they do exactly what we think life will be in the future. It's scary, but I think that's where things are going. So let me stop here since I took my 20 minutes and open the floor to questions.
Thank you, Dr. Antoniades, for virtually being here with us today and for the very insightful and informative talk. I personally, and I'm sure many of our attendees today, have been trying to wrap our minds around NFTs and the metaverse and the new market. So let's start with our Q&A session. I would like to remind our audience that they may submit their questions in the Q&A box, and we'll try our best to answer all questions today. We have a question from one of the attendees. Are NFTs and digital assets immune from inflation?
Very good. I think that's an excellent question. And we all try to understand, because as prices are going up, we try to think, is there an alternative to that? So I go back to what I said about inflation. Inflation is driven by an increase in prices that comes from fundamental supply and demand. And NFTs is really about scarcity, controlling the supply, but increasing the demand. And the other driving force of inflation is expectations that become self-fulfilling. And definitely in the case of NFTs, I'll start with expectations and the psychology of the market. I think they are more prone to inflation coming from self-fulfilling expectations. And because they're more prone to expectations, what we have seen is manipulation in the NFT space, because it's not as regulated as stocks, whereas you have wallets that are buying and selling NFTs. So the same wallet will buy for a huge amount just to push the prices up, to make artificial inflation by controlling the supply and demand for NFTs. And then by using the spike in price to create expectations of rising prices, to encourage people to jump in and make an investment by buying the NFT, and that hopefully will push the price up even more, so the people that have the NFTs benefit from it. So we have seen a lot of manipulation in the space of the NFTs, and for that reason, for how easy it is to create inflationary pressures there, not driven by fundamentals, but by manipulating supply and demand and expectations, the psychology of the masses, I think many platforms stop doing trades in NFTs. And I think the reason why NFTs will not take off for a few more years is because we need to figure out exactly how to prevent manipulation and shield NFTs from rising we can have some inflationary pressure if we think of NFTs as assets. That is fine. But manipulating the price and creating an artificial inflation, that's a big problem the NFT world has to solve.
Thank you. Going to tie the next couple of questions together since they're related to Qatar. The first one is, how will the political uncertainty caused by Russia's invasion of Ukraine affect Qatar's business and trade ties with its traditional partners such as the US? And the next relevant question would be, based on your macroeconomic outlook, how would Qatar be affected?
All right. Thank you, Dima. Yes, so the current situation has implications for all of us, regardless of industry, regardless of where we are, which country, especially for Qatar, right? This is I think it's a lose-lose situation. Let me put that. But I think there are some positive points for the state of Qatar, and let me start with one. The first one is that Qatar has initiated the expansion of the North Field. This is where LNG is being produced. And the plan is to increase the supply of LNG by 60% in the next 5 years by raising it by 1.4 billion tons. So in 5 years, we will have a lot of LNG that we need to sell to countries. We need to establish contracts. And what we see now, before we even start building the expansion, we have a line of countries waiting to sign long-term contracts with the state of Qatar to secure their energy needs and provide energy security for their people. So Qatar is a winner in this situation because they can negotiate those contracts, they can finalize those contracts, and they have more bargaining power on the terms 5 years before they even start producing. And the reason why they have that is because countries know that if they wait 5 years until LNG is available, Qatar may not have extra capacity to sell. So everybody wants to be in front of the line and have a nice agreement with the state of Qatar. So Qatar benefits big way with that. I think, and I don't talk just about Qatar, but I think we may see a lot of companies, especially tech, gaming, coding companies that are based in East Europe, eventually moving to the Gulf. We have seen Goldman Sachs moving its stuff from Russia to Dubai. You have seen many companies coming to Doha and to the UAE. So that's another area where the country can benefit. And the fact that Qatar has good relations with its neighbors, good relations with most countries, makes this a safe haven, in a good way of the word, not in a tax sense, for those companies and stuff to be. In terms of relations with the US, I think that also creates a lot of business opportunities for US companies that are actively pursuing business in Qatar, because most of the income of the country, of the state of Qatar, comes from LNG. So when the income goes up, the spending goes up. We have a pro-cyclical fiscal policy. When we have money, we spend more. When we don't have, we don't spend. And when more money is spent, it goes to local companies, but also international. And we also have to think about soft power. It's very important in this uncertain environment for any country to have soft power. And how can we ensure, how can we get soft power, is by building relations and stronger relations with many countries. And of course, US would be at the front of the list. So directing some of that spending to US companies, I think, is one direction the state of Qatar tries to ensure that our relation is very strong. Now, the other question you asked me is about the macro environment, the macro outlook of the country. Let me remind the audience that Qatar has a currency that is pegged to the US dollar. That is, our currency is 3.65 riyals for $1. It has been like that for 40 years. The implication to that is that we don't have monetary autonomy. The implication is that we have to follow the interest rate policy of the US. So if the US raises interest rates, we have to raise interest rates. If we don't do that, then all the money from the banking system here will go to the US. Why get 1% interest rate in Qatar if you can get 5% in the US and you don't need to worry about the exchange rate if the exchange rate is fixed? Similarly, if the Fed lowers interest rates, which is what they've done in 2008, when inflation here was for 14%, we had to lower interest rate. So the implication is that interest rates in Qatar will be going up. That will put a lot of pressure, especially on developers that got very big loans from the banks. I think that may put pressure on banks, but I think overall the financial environment is strong, so I don't anticipate any increase in defaults or any substantial economic issues. Again, because while we have this cost of rising interest rates, we are doing very well on the LNG. Prices are high, we're increasing production, and we are selling.
Thank you. So, Dr. Antoniades, on Monday, the Chinese stock market dropped by as much as 7.8% as it fears of sanctions against China and Chinese firms started to spread. This was, of course, due to stories that Russia requested military help from China. How would a scenario of sanctions against Chinese firms affect markets, and what implications would that have on the Fed's decision to raise or not the interest rates?
Yeah, thanks. So I think for investors, I think the situation is in Ukraine and Russia is well understood, if one can say that. We know what is going on, but the big uncertainty, the big elephant in the room is what may happen with China, and that scares people. Let me first explain why that scares people. Of course, it's obvious, but the US runs a current deficit. That means the US borrows, and most of the money comes from China in terms of US treasuries. So if China stops buying those treasuries, and if China requests that the US takes back those treasuries, that would be a huge problem both for the US, but also for China, because it's a lot of money. But if you look at companies, if you look at Apple, most of the profits come from China. Most of the growth is in China. So for US companies and even European, for Porsche not selling some cars to Russia, that's just cosmetic. There's such a shortage in cars that the fact that you don't need to send them to Russia helps you send it to the clients in other countries that have been waiting for about a year. But when you talk about China, that's a very big market. That's where you see the growth over the next 20 years. That's where investors invest in your stock because they see the growth. So if for some reason something happens to that market, not only do you lose sales, but even in the US, you cannot sell because all the parts come from China. So China is so different. That's why China is a big elephant. Now, what we have seen starting from last week, end of last week, is the US saying that they have information Russia requested support, military support from China. And that set a shockwave to the markets. And the stock market in China went down on Monday. And then on Monday, the US further reiterated the point, and they were more specific. They said that the Russia government requested drones from China. And again, we've seen the market going down. Why? Because investors panic. If something happens and US starts imposing sanctions against China, then China will retaliate. And that's a black swan event that nobody wants to even think about. That's when you will see markets in free fall. So today there was a very interesting announcement because, well, let me tell you, there was an interesting announcement, very generic, but very specific at the same time, coming from the Chinese authorities, saying that the Chinese authorities will secure the real estate market, will support the stock market, will make sure that Chinese economy is not affected by the current disputes going on in the world. They didn't say how they will do it, but the moment they made this statement, you've seen markets rally. Alibaba was at some point up 20% in just one day. We've never seen such a big increase in markets since 2008. I think Alibaba is up 14% now. So what you can read into this is two things. From the point of view of China, maybe it's a confirmation that China will not do anything vis-a-vis Russia, or it could be that things were so bad, getting so out of control that panic could take over in the markets in China, and then this selling would accelerate, So they had to step in and make an announcement just to stop the selling and hope that this is a credible announcement. So credibility is key. And I think in the coming days, markets will judge whether this is credible or not. The buying we see now is because of emotions, because of psychology, because of expectations. But in the coming days, market participants will ask, is this announcement credible? Will China actually commit and be able to do what they said? I think the other interesting thing to me is the US. So all of a sudden, the US makes this announcement, and I'm sure they have information. So why would they make that announcement? Do they want to have a direct conflict, not military, but economic conflict with the US, with China? I doubt that's the case. But I think, and I'm speculating here, right? I think what is happening is the US realizes that they have to ensure that China takes a stance. So they have to put the information out there. Joe Biden will fly to Europe to meet with the Europeans to put even more pressure on China to take a position. And hopefully the position of China will be, listen, we have a lot of internal problems right now, especially with the real estate sector. This is not a problem we want to get into. So let's work with the US, let's work with Russia and end this conflict. I think this is where the US is trying, what the US is trying to get out of it. I hope they succeed. Also, I think, and again, I'm not a political scientist. I'm very good with inflation and looking at the data, you know, and deciding based on the data. Here we have no data. It's what the president of Russia decides to do on a given day can change everything. But I think President Putin is more reactionary than the president of China. China always likes to plan ahead, not to react to things. So it's very hard for me to think that China will take a position now and not prepare over the next 20 years for something, you know, they want to do. So I hope this pressure by the US will not translate into economic sanctions and frictions with China, but it will be a message that, okay, we all need to get together and end this very soon. But time will tell what the problem is. It's just that given that there is uncertainty, even if the likelihood of some frictions is very small, the consequences are humongous, and markets have to factor that in.
And building on this discussion, do you think that the war in Ukraine and the various sanctions that followed will spearhead the adoption of crypto coins, or will they actually have an opposite effect as regulators across the world now take a closer look at the crypto coins?
Yeah, indeed, this is very interesting. Everybody is trying to assess now whether, and let's talk about the SWIFT. One of the first things NATO countries did was to kick Russia out of the SWIFT, of the system that allows them to make payments. So that, to many, that means that there's one way to go. You need a new system that cannot be manipulated by governments, and that's the crypto space. So to some, maybe this is what was needed for the crypto space to go mainstream. At the same time, we have seen the US and also Europe with regulation trying now to regulate the crypto space. So enhancing regulation, taking a closer look at that space, identifying wallets belonging to Russian oligarchs. So while at the same time we see this clearly makes a case why you need to have this alternative system that cannot be touched by authorities when they decide to touch it. At the same time, we see that authorities can regulate and can influence and can track the crypto space. So I think it will take time to realize if authorities can actually regulate to the extent they want. We've seen that the regulation announced last week and what Europe is trying to do has not been very harsh. But I think it will take time to see. Personally, I think once the smoke settles and the situation is resolved, and hopefully soon, we will see a move towards the crypto space. I think moving there is one direction. It's just how fast we will move there, the question in my mind. And I think what is happening now, once things clear and the war ends, will accelerate the move. But the second question is, we are moving in this direction, but the instruments we will be using and the technology may not be the one we have now, may not be the altcoins and meme and the coins we have now. And the DeFi systems we have now may not be the ones we will have in the future. Maybe we need to reinvent. And what happens in every crisis, there is a lot of innovation. It's a lot of creative distraction. So, and in this crisis, we will realize that some of the crypto tools we had don't really get the job done. So that will lead to a lot of innovation. So the one thing I will be able to say for sure is that this shock to the markets, to the traditional system and to the cryptos will lead to a lot of innovation in the coming months and years.
Thank you for that. And so based on what's happening to the economy today, could you briefly compare today's global economy to the economy during the last financial crisis in 2008, given the emergence of NFTs, crypto coins, and the metaverse? Will this complicate the recovery of a financial crisis, or will it provide easier solutions?
So in 2008, what we have seen was a lot of free money in the system. We've seen a lot of liquidity, but really it was about mortgage-backed securities. We have seen it was the American dream to own property, and even from Bill Clinton and President Bush, they pushed for the American dream. They really pushed for home ownership, and at the same time, because the banking system in the US in the 80s changed from having license only in one state to having license to many states. And to get that license, you had to go into community boards, and you needed community groups to vote for you, and you would do that in exchange of giving them lending. So improvements in financial situation with this ease of lending created a bubble and created the mortgage-backed securities, and that was the beginning of the financial meltdown of 2007, 2009, and that spread. What do we see now? We've seen that the Fed has been pumping money up until a few months ago, and now they decide to start taking out some of the money they put into the system every month and waive out that program. But a lot of the money went to the market. But now the situation is different. We have a geopolitical crisis. We have a war that affects supply of many inputs, commodities. We have very high inflation. We didn't have that in 2008. We did have it for some period for commodities. So I think the situation is very different. How we came out of the crisis in 2008, Europe and the US took a very different stance. In the US, it was all about increasing the money supply, slash interest rates, put a lot of liquidity in the money. Actually, the banks had 800 billions in their books. After the crisis, they only had 80 billions before. So they took this extra liquidity and they kept it in their accounts. They didn't give it out. But Europe took a different approach. They said, we will not put a lot of liquidity. We will not lower interest rates and risk inflation. We will try to solve structural problems, especially in South Europe, in Italy, in Greece, in Spain, in Portugal, and so on. So it was a very different approach. Of course, inflation didn't come for a decade, and Europe struggled for a decade. But how you get out of this is very different, because in 2008, you slashed interest rates and you pumped a lot of liquidity. Inflation wasn't a problem. Now the problem is inflation. So how the Fed needs to react is opposite of what they did in 2008. But it's very hard to make predictions because we don't know how this thing may end. If tomorrow the problem is resolved, commodity prices will go down, that will ease inflation, and maybe the Fed will raise interest rates, will cause some recession to control the demand for goods and bring prices down. I think companies and markets can tolerate that. We have many bubbles, especially in real estate. There's a lot of air that needs to come out. There will be some suffering, definitely. Stock markets may drop, especially in emerging markets, in developing countries, in South Asia, but it's a very different situation from 2007, 2009.
We have one final question before we conclude today's session relevant to the US and elections. So in the past, the state of the economy always affected elections outcomes in the US. How do you think, Dr. Antoniades, the current economic environment may affect the incumbent during the next elections?
Thank you, Dima. Yes, it turns out that the most studied subject in political science is the impact the state of the economy has on affecting election outcomes. And the finding is the following, that the state of the economy matters for elections. So when the economy is not doing very well, the incumbent loses votes. What is interesting is that after that, we don't know exactly why. So what is it about the economy? Is it about prices that affect voting? Is it unemployment? Is it about dropping income? Research is inconclusive. It always changes by election, by setting, and so on. I think given the current situation, what we can see is, of course, the American people will get behind the US and will support the president for the most part. So that helps the Democrats. But at the same time, with rising inflation that eats into the purchasing power of households, when rents are going up and that frustrates voters, that creates a lot of pressure on their budgets, and that will affect how many votes the Democrats will get. So you have these two effects that run in opposite directions. I think the Democratic Party will be judged by the ability to manage the geopolitical situation in Ukraine and Russia, and then their ability to control inflations. If they manage to put an end to the war and to control prices, and they still have time before the next elections, I think this will benefit them. But if we get closer to the elections and the world looks even more scary than it looks now, or it looks safer only because the US made a lot of concessions, and the economy is not under control, inflation is not under control, then I think Republicans have a very big chance.
Thank you, Dr. Antoniades, for answering these questions. And I would like to mention to our attendees, they may submit their questions to us after the session, and we'll do our best to get back to them. Before we end today's session, I would like to thank you again, Dr. Antoniades, for being our guest speaker for today. And I would also like to thank Georgetown University School of Foreign Service in Qatar for being our partner for over the past 2 years. And last but not least, I would like to thank our attendees for joining today's session. Thank you, everyone.
Thank you.